Futures trading. Understanding margin. Unlike stock trading, where you usually pay the full price of shares up front, futures trading relies heavily on the concept of margin. Margin in futures is not the same as borrowing money or leveraging debt in the traditional sense. The futures market is overseen by clearinghouses, which act as intermediaries between buyers and sellers. The clearinghouse ensures that contracts are honored, and one of the ways it does this is by enforcing strict margin requirements. Instead, it is a good faith deposit that ensures both parties involved in a contract have enough funds to honor their obligations. When you enter a futures contract, you agree to buy or sell an underlying asset at a specified price and date in the future. To ensure that both sides of the agreement are financially committed, exchanges require traders to deposit a percentage of the contract value. This deposit is called margin. Think of it as a security bond rather than a down payment. Margin in futures serves two main purposes. First, it ensures that traders have skin in the game. Without margin, a trader could take on huge positions without the means to cover potential losses, which would increase the risk of default. Second, margin requirements protect the integrity of the futures market by reducing the possibility of one trader's failure spreading to others. The futures market is overseen by clearinghouses, which act as intermediaries between buyers and sellers. The clearinghouse ensures that contracts are honored, and one of the ways it does this is by enforcing strict margin requirements. Unlike in stock trading, where you might pay for shares up front or use borrowed money for leverage, futures contracts require a good faith deposit that is continuously monitored and adjusted. Just a quick reminder to please hit the like button and subscribe to the channel. Also, you can visit us on the web at investmentees.com and use the code BLOG to receive 25% off your next purchase. Margin requirements are the rules set by exchanges or brokers regarding how much money must be deposited to open and maintain a futures position. These requirements vary depending on the contract being traded, the volatility of the underlying asset, and the risk appetite of the clearinghouse. For example, trading futures on crude oil may require a higher margin than trading futures on corn because oil prices are typically more volatile. Margin requirements are not static, they can change based on market conditions. During times of heightened volatility, exchanges often increase margin requirements to protect against larger potential losses. For traders, this means they need to keep an eye not only on price movements but also on margin levels. The key components of margin in futures are the initial margin and the maintenance margin. Together, they form the backbone of margin requirements, ensuring that traders can sustain their positions while also safeguarding the financial stability of the exchange system. The initial margin is the minimum amount of money you need to deposit in your trading account to open a futures position. Think of it as the entry ticket to the futures market. It is not the cost of the contract itself, but rather a fraction of the contract's total value set aside as collateral. For example, imagine you want to trade a futures contract on crude oil. Let's say each contract represents 1,000 barrels of oil, and the current price is $80 per barrel. The total contract value would be $80,000. However, you do not need to deposit $80,000 to open the trade. Instead, the exchange might require an initial margin of 10%, meaning you would need $8,000 to enter the position. This system allows traders to control large positions with relatively small amounts of capital, which is one of the primary attractions of futures trading. However, it also means that potential losses can be magnified, since a relatively small change in price can significantly impact your margin account. Once you have opened a futures position by depositing the initial margin, the value of your contract will fluctuate daily as the underlying asset's price moves. If the value of your margin account falls below a certain level, known as the maintenance margin, you will be required to deposit additional funds. The maintenance margin is essentially a minimum balance requirement that ensures you always have enough collateral to support your position. If your account balance drops below this level, your broker will issue a margin call, requesting you to top up your account back to the initial margin level. For instance, let's revisit the crude oil futures example. Suppose the exchange requires an initial margin of $8,000 and a maintenance margin of $6,000. If the market moves against your position and your account balance falls to $5,800, you would receive a margin call. To continue holding the position, you would need to deposit enough funds to bring your account back to the initial margin of $8,000. This mechanism ensures that losses are contained and that the trader has enough capital to cover future price fluctuations. Maintenance margin acts as a safety net, protecting both the trader and the broader market from excessive risk. A margin call is a broker's demand for a trader to deposit additional funds when the account balance falls below the maintenance margin. While the term may sound intimidating, margin calls are simply a routine part of risk management in futures trading. For example, suppose your margin account falls to $5,500 when the maintenance margin is $6,000. Your broker will notify you that you must add $2,500 to bring the account back to the initial margin of $8,000. If you fail to do so, the broker has the right to liquidate your position to prevent further losses. Margin calls highlight the importance of monitoring positions and keeping a buffer of funds in your trading account. Traders who run their accounts too close to the minimum requirements often face forced liquidations, which can lock in losses at unfavorable prices. Understanding margin requirements is critical for several reasons. First, margins allow traders to participate in futures markets with less capital than would otherwise be required. This leverage is one of the primary attractions of futures trading, but also one of its greatest risks. A small movement in price can result in significant gains or losses because the trader is controlling a large contract with a relatively small deposit. Second, margin requirements help maintain the stability of the financial system. By requiring traders to deposit initial and maintenance margins, exchanges minimize the risk of default. Without these safeguards, one trader's inability to meet obligations could ripple through the entire market, leading to widespread instability. Finally, understanding margin helps traders manage risk effectively. By knowing how much capital is required and how fluctuations in price affect their margin accounts, traders can make more informed decisions about position size, stop-loss levels, and overall risk exposure. To understand how initial and maintenance margins function together, let's walk through a simplified example. Imagine you open a long position in one crude oil futures contract at $80 per barrel. The contract represents 1,000 barrels, making the contract value $80,000. The exchange requires an initial margin of $8,000 and a maintenance margin of $6,000. On day one, you deposit $8,000 into your margin account, and your position is established. If the price of oil rises to $81 per barrel, your contract gains $1,000 in value. Since each $1 increase equals $1,000, your margin account now holds $9,000. However, if the price of oil falls to $79 per barrel, your contract loses $1,000. Your margin account balance drops to $7,000. This is still above the $6,000 maintenance margin, so you do not receive a margin call. But if the price falls further to $78 per barrel, your loss increases to $2,000, and your margin balance declines to $6,000. At this point, you are exactly at the maintenance margin. If the price slips even slightly below $78, your balance will dip under $6,000, and your broker will issue a margin call, requiring you to replenish your account back to the $8,000 initial margin level. This daily process of adjusting account balances according to gains and losses is called marking to market. It is one of the most important features of futures trading, ensuring that profits and losses are settled on a daily basis and that traders always maintain sufficient funds in their accounts. Real-world example: S&P 500 futures. To see how margin works in a real-world context, consider S&P 500E mini futures. These contracts are among the most popular futures instruments globally. As of a recent requirement, the initial margin for one E-mini contract might be around $12,000, while the maintenance margin is set at $11,000. Suppose you go long one E-mini contract, which is valued at $50 times the S&P 500 index level. If the index is trading at 4,000, the contract value is $200,000. With a margin requirement of only $12,000, you are controlling a $200,000 position. If the index rises by 20 points to 4,020, you make $1,000, 20 times the $50. That's an 8.3% gain on your $12,000 margin. However, if the index falls by 20 points, you lose $1,000, which represents an 8.3% loss. This example shows how futures margins amplify both potential profits and potential losses. Conclusion: margins are the foundation of futures trading, balancing the need for leverage with the necessity of risk control. The initial margin serves as the entry ticket to a trade, ensuring that traders commit sufficient capital upfront. The maintenance margin provides an ongoing safeguard, requiring traders to maintain a minimum balance and replenishing it when necessary. Together, these requirements protect traders, brokers, and the financial system as a whole. For traders, understanding margin is not optional, it is essential. Without a clear grasp of how margin requirements work, it is impossible to trade futures responsibly. By learning how initial and maintenance margins function, monitoring account balances closely, and applying sound risk management strategies, traders can harness the power of leverage while avoiding its dangers. Futures trading offers enormous potential, but it is not without risks. Margins are the mechanisms that allow the market to function fairly and securely. Mastering the concepts of initial margin and maintenance margin is a vital step for anyone looking to succeed in the exciting, fast-paced world of futures. Thank you for watching.